So we're going to take a look at this Serena question. This is an incomplete records question that came from the Specimen paper. It's question 15 in the 2018 paper 1, 7127-1. So the business was opened on the 1st of January 2014. So she's been trading for a year because we're doing the accounts to December 2015. So we've got some details of opening and closing balances, opening and closing inventory. We've got other payables, rent of shop premises, so that's an accrued expense. We've got an accrual there. We've got other receivables at the start of the year, so she's got a prepayment for rent paid brought forward. We've got some shop fittings that have gone down in value. Net book value is lower from one year to the next, so down to some depreciation, possibly disposal of an asset as well. We've got trade payables at the start and at the end of the year, and then a summary of her bank statement. So opening balance in the bank, 2,300. She's banked some cash takings. She's made payments to trade payables. She's taken some drawings, sold some shop fittings. She's paid rent, and she's paid for some general expenses. And then we've got some additional information. And what we're asked to do is to prepare the trading section of the income statement, and we have to show the value of goods taken for own use. So that's going to be a missing figure there. That's part 1. And then, got some extra space. And then part 2 of this question for another 6 marks is to complete the income statement. So starting with the gross profit that we'll have calculated in part 1. And then we've got a little bit of writing to do. So 14 marks coming from computation, 6 marks from writing about the performance of the business. So let's go back to this additional information. At the 31st of December, there are unpresented checks. So I don't know if you can remember from bank reconciliations, an unpresented check is one that's been written and issued but not yet cleared through the bank statement. Now remember, this is a summary of bank statements. So we've got unpresented checks for payments to trade suppliers totaling 2,330. So they are not included in that total there. So when we come to use that figure to work out our purchases in a little while, we need to include those unpresented checks. And she's also got amounts for cash takings not yet credited. So these takings are going to need to include that 1960 that she hasn't yet banked. So that will be going towards our sales figure. Serena remembers that she took some goods for her own use during the year, but she's unsure of the value of these goods. So we're going to have to work out goods for own use there. We don't know what that figure is. It's going to be a missing figure. All purchases are on credit. So we've got payments to trade payables, which we're going to need to adjust for the opening and closing trade payables figures up here. All sales are on a cash basis. So this is going to be to do with the cash takings that are banked there. We've got some shop fittings that have been sold that had a net book value of 750, where they were sold for 390. So we're going to have a loss on disposal of the difference there. So 750 minus 390 is going to give us a loss on disposal of £360, which is going to go into our income statement as an expense. And Serena's policy is to have a markup on all goods sold of 25%. So remember, markup is gross profit expressed as a percentage of cost of sales. So she's adding 25% onto her cost to get to the selling price. So that's going to be really useful to us when we come to work out the missing figure for goods for own use in the income statement. So we're going to do the income statement. I'm not going to bother, in the interest of time. You should head this up as an extract from the income statement for Serena for the year ended 31st of December 2015, but I'm just going to be a bit lazy here and not bother with that. Now we know that with the income statement we want sales, we want cost of sales next, so I always think label that up. Cost of sales in this case is going to comprise opening inventory, it's going to comprise purchases. We're going to have to take away from that the goods for own use. And we're going to have closing inventory in there as well. And when we add and subtract all of that lot, that will give us the total for cost of sales. And what we're aiming to do here, because it's just an extract for the trading section, we're trying to find our gross profit for the year. Now, one thing to bear in mind is that we've been told about the markup. So gross profit is going to be 25% in relation to cost of sales. So total cost of sales is going to make up 100%. We're going to add 25% gross profit. So sales is going to be 125% of our cost of sales. So we're going to be able to use that markup figure there to calculate some missing figures. So I suggest that we start with sales. Sales is going to be relatively straightforward. All of the sales on a cash basis. So it's just a case of adding those two figures together there. So we've got 1960, which if you remember was the takings that she hadn't yet banked, plus the 228,730. So sales is going to be a total of 230,690. I'll pop that in at the top there. Okay, then we can start assembling our cost of sales figure. So we've got the inventory there. There's no need to make any adjustments. There's no problem. We haven't got any goods that we need to value at the lower of cost and net realizable value. So opening inventory was 18,940. And then I'll just tick that off as we use it. And then our closing inventory is going to be 14,720. So we're going to be deducting that there. Now purchases, we've got the payments that we've made to the trade payables. So I'm going to make a little calculation here. So paid to trade payables during the year is a total, it's 178,300 plus 2,330, which is 180,630. But we already owed them 143,730 from before, so we need to take away the opening trade payables. So we owed them 14,730 at the start of the year. So some of that 180,630 is going to include last year's trade payables, and then we're going to need to add closing trade payables. We haven't paid them yet, 16,390. So our purchases figure is the sum of that lot. So 180,630 minus the 14730 plus the 16390. So we've got a total there of 182,290. So that's going to go into our purchases figure, 182,290. Now remember, we've got this missing figure, goods for own use. So we're going to have to work backwards here. We've already worked out that the sales are going to be 230,690. Now because our cost of sales is marked up by 25%, that sales figure represents 125% of cost of sales. So if we divide the sales of 230,690 by their relevant percentage there, so 125, and then times it by 100, that tells us that cost of sales needs to be 184,552. We can do the same process to find the gross profit. So divide by 125 and then multiply it by 25. So always divide by the one you know here and times it by the one you want to find. So that means our gross profit is going to be 46,138. Now there are umpteen different ways of doing this, but I just find this is a consistent way that most students, even with a limited grasp of maths, can understand. Okay, so now all we've got to do is work out the total of these. So we've got the 18940 plus 182,290 minus the 14,720. So at the moment we've got 186,540 in our cost of sales, but we need it to be 184,552 so that the percentages stack up there. So that means that our goods for own use, which we're going to deduct from purchases and add to drawings, are 1,958. Okay, so the maths now works. Right, second part of this. So that's 8 marks in the bag. For another 6 marks, we've got to sort out, there's the page, the income statement, complete the income statement. Again, I'm going to leave out the title, but I would encourage you always to put a title in there. So we've got gross profit, and that's coming from 15.1. So you would be getting an own figure mark. So if you made a mess of this, just bring the figure forward. We've got no other income on here, so now we can just say less expenses. Okay, and we can just work through the list of expenses. Now we've got some stuff to do with rent of shop premises here, so I'm going to suggest we start with the rent. We've got the rent paid, which is 14350. Okay. Now, at the end of the year, we've got an accrual. We have to remember to add accruals. So we add a closing accrual because it increases the expense. We've got a prepayment, but the prepayment is at the start of the year. Now, prepayments at the end of the year are deducted. With an opening one, we do the opposite. So we actually need to add 830. It was prepaid last year, but it relates to this year's rent. So our total for rent is going to be the 14350 plus 950 plus 830, which is £16,130. Okay, we've got general expenses. We can just stick those in. I don't think there's anything to worry about with general expenses. So we can just pop those straight in, 9470. There's no accruals and prepayments we're told about there. Now we've got the loss on disposal. If you remember, we worked that out before. So the loss on disposal is 360. And then I think the only other figure we need to work out is the depreciation on our non-current assets. Now, that's another one where I'm going to do a little asterisk and then show the workings. Now, the starting point for working out depreciation is going to be the net book value brought forward. So whatever it was at the start of the year is 32,400, because what we're trying to do here is explain why it's gone from 32,400 to 29,600. Now, the difference is not just going to be depreciation, because if you remember, we've got rid of an asset, so we need to take that into account. So I think the easiest way to do it is just to start with the net book value brought forward, which was 32,400, minus the disposal. Okay, we need to take that off at the net book value. So let's find the net book value of the thing that was sold. That was £750. Okay, and then take off the net book value carried forward, which is 29,600. And then the total of those, so 32,400 minus 750 minus 29,600 is the depreciation, which is 2,050. So we can pop that in, £2,050 of depreciation. That's all the expenses, nothing else to worry about here. 9,470 plus 360 plus 2,050. So the expenses, 28,010, which means that she's got a profit for the year is a profit of 18,128. Okay, so that's another 6 marks in the bag. The last part of this question, it says that Serena has told her accountant she is disappointed by the business's performance. Her accountant has looked at the business's results for the year ended 31st of December 2015 and has highlighted the fact that revenue has fallen by 10% and the rate of inventory turnover has worsened. It's slowed down by 20 days. So it's taking 20 days longer than previously to get rid of the inventory. So what we've got to do is assess the actions that Serena could take to overcome the weaknesses highlighted by the accountant. So let's talk about the revenue first of all. So revenue, sales revenue is made up of 2 components. It's the selling price and it's the volume of sales. So if she wants to improve her revenue, she could put her selling price up. The likelihood is, though, that that will lead to a reduction in the volume of sales. If she increases her selling price, customers may go elsewhere. So we need to think about the effect that that would have on demand. Conversely, she could look at putting her prices down to try and stimulate demand, but she'd need to make sure that overall that did lead to more profitability. Okay, so it may not improve her revenue overall. She could look at advertising. At the moment, it doesn't look, we don't know what's in general expenses, but we can't see anything separately identified. So maybe she could do some marketing, some advertising, but obviously we'd need to think about the impact that that would have on her overall profit. So there's no guarantee it would work. So she may end up reducing her profit as a result. At the moment, all of her customers are cash customers. So maybe she could look at offering them credit, but obviously the problems with that, it could put a strain on her cash flow because they won't pay her for a while, and it will also increase her chances of irrecoverable debts. Okay, so some ideas there, things we could write about. If we talk about inventory, so we need to think about things that would speed up the inventory turnover. And it looks like she's already reduced her inventory from one year to the next, so could she reduce that further? Problems with that, though, could result in running out of stock, so not being able to satisfy customer demand. She could look at maybe reducing her cost of sales. That would help to speed up inventory turnover. She could do that maybe by getting a cheaper supplier, but then she would need to think about the impact that would have on the quality of the goods that she's offering. So whenever we think of ideas to improve these ratios, there's often a flip side to it. So something else is going to suffer. If she reduces the selling price, anything she does to stimulate demand, so the same idea as improving revenue, she could introduce a reduction in selling price, but that may have a detrimental effect on her profitability overall. Okay, so hopefully that's given you some ideas of things to write about. Thanks very much for watching. Don't forget to like and subscribe.